When you invest money, it earns a return. When that return begins earning its own return, your wealth accelerates. It creates a self-sustaining cycle where your money works independently of your labor. Compound interest operates as a foundational engine for wealth. Its reputation among history's most logical minds stems from its predictability. Given enough time, the mathematics of growth become inevitable. This chart shows the math. Investing $100 monthly in an S&P 500 index fund can grow to $637,000 over 40 years. You only contributed $48,100. The remaining $588,900 is the product of compounding. Time did the heavy lifting. To protect this growth, you must avoid being forced to sell during a crisis. If you invest your last $100 and then face a $300 car repair, you'll be forced to liquidate your shares at a potential loss. Build a $500 to $1,000 cash buffer first. You must also address high-interest debt. The stock market averages roughly a 10% annual return. If you carry a credit card balance at 24% interest, that debt grows twice as fast as your investments. Paying off high-interest debt is your best guaranteed return. Opening an account requires your Social Security number, a government-issued ID, and your bank routing details to fund the initial $100 deposit. Having cash on hand and zero high-interest debt ensures that the physics of compounding can work for you without being interrupted by personal financial emergencies. An investment account is a container with specific tax regulations. It is separate from the assets you choose to put inside it. Your first priority is any available 401k match offered by your employer. An employer match is capital added to your account by your company. If they match 50% of your contribution, you receive an immediate guaranteed 50% return that no market asset can consistently replicate. After securing the match, the Roth IRA is the ideal second container. Because you contribute after-tax dollars, every cent of growth you earn over the coming decades can be withdrawn entirely tax-free in retirement. This table compares the major providers for a Roth IRA. Fidelity and Schwab offer zero account minimums, while Betterment provides an automated portfolio for a 0.25% annual fee. Any of these allow you to start with your first $100 today. Choosing these specific containers prevents the future loss of thousands of dollars to capital gains taxes. Once your container is funded, you must move the cash into an actual investment. Leaving the money in the account without purchasing an asset will result in zero growth. The foundational asset for most beginners is an S&P 500 index fund. A single share of this fund distributes your $100 across the 500 largest publicly traded companies in the United States. This strategy provides instant diversification. Professional investors like Warren Buffett recommend index funds because they protect you from the failure of any single company while capturing the growth of the broader economy. You can choose the manual path by buying funds like VOO or FXAIX, or use a robo-advisor like Betterment to handle the portfolio balancing for you. Both are effective ways to put your $100 to work. Avoid gambling your starting capital on cryptocurrency or meme stocks. These assets are subject to extreme price swings that can erase half your investment in a matter of days. Momentum-driven trading often leaves late-arriving beginners buying at the peak, while the people who promoted the stock have already sold for a profit. An index fund protects your initial $100 by tying it to the long-term productivity of the entire national economy. To make this system permanent, set up a recurring monthly transfer. Instruct your app to automatically move $100 from your bank account into your chosen fund every month. Automation eliminates the friction of having to choose to invest each month. The money moves before it can be used for non-essential spending. You must prepare for the fact that the stock market will drop. Double-digit declines are a normal, recurring part of the economic cycle. This chart highlights a sharp market dip. For someone adding money every month, this is not a destruction of value, it is a discount event. Because your $100 transfer is automated, you continue buying when prices are low. This process, called dollar-cost averaging, allows you to acquire a higher volume of shares for the same amount of money. History shows that investors who hold through these cycles consistently outperform those who try to time the market by selling during a dip. Combining an automated system with a disciplined mindset transforms market volatility into a mechanism for building wealth. Once these steps are in place, your foundational wealth system is fully operational. Because the system handles the technical execution, you are no longer required to make a high-stakes emotional choice every morning. That removal of daily friction replaces constant market checking with the knowledge that the math is already in motion. If this approach helps you, like the video and subscribe to USFINOX for future investing strategies. This single action secures your initial capital against the mistakes of market timing. You have moved into the role of a capital owner, holding a permanent stake in the productivity of the world's largest companies.